All right, thanks for having us. We're always happy to join the group here of the Festival of Traders. And let's just jump right in because we've got a short period of time and a lot of information to talk about. Today we're going to talk about how to trade volatility in a world that lacks it, specifically buying or selling into volatility, but doing so with a hedge. Anybody that's ever traded volatility using the VIX or an ETF or anything like that has probably learned the painful lesson that trading volatility is not for the faint of heart. So if you're not aware of who I am or what I do, I am a futures and options broker in Las Vegas, Nevada. My name is Carly Gardner. If you have any questions about anything we talk about today or anything in general, you can either give me a call or send me an email. You can also feel free to visit our website. It's DeCarleyTrading.com. We have several educational videos, articles, you name it, we have it there. Our goal is to teach people before they get involved in the markets. And if you're on social media, we're on Instagram, Facebook, Twitter, you name it, we're there. Just for a little background information, I do write a column for Stocks and Commodities magazine. You might have seen the Futures for You column there. I also write a couple of newsletters for our brokerage clients. Some of them involve general market commentary on commodities and financial futures, but we also provide specific trading recommendations. And I do provide content for Jim Cramer's Mad Money on technical analysis, usually of commodity markets like gold, silver, copper, energies. I've written 4 books on commodity trading. The newest is Higher Probability Commodity Trading. It can be purchased at Amazon with free shipping, which is an awesome benefit because it's a big book. It's not necessarily cheap to ship. But we are also offering a special. If you buy Higher Probability Commodity Trading from our website, which is right there, higherprobabilitycommoditytradingbook.com, we'll give you a free copy of Currency Trading the Book, which is a book that I wrote a couple of years ago and highlights the differences between trading currencies in the futures and forex markets, regulations, leverage, all those types of things. Now, before we get started, just want to make sure everybody understands that there is a substantial amount of risk in trading futures and options. It's not suitable for everybody. It's not necessarily an investment. It's trading. We're trying to beat the markets. There's no interest or dividends. It's pure speculation. Okay, everybody wants to play volatility. If you've ever been in a trading chat room or on Facebook or Twitter, you see people talking about it all the time. Well, what is volatility? Volatility is defined outside of finance as the liability to change rapidly and unpredictably, especially for the worse. And I think anybody that's traded volatility will say it probably means about the same thing. In theory, volatility is generally assumed to be a statistical measure of dispersion of returns for a given market. So volatility could mean in either direction in theory, but when we're talking about trading volatility, we're generally talking about the negative type of volatility, which means the stock market down, volatility up. And that's what we're going to focus on today. Volatility plays are popular, but they are dangerous. And I want to make sure everybody understands that. The stakes are high and the certainty is low. And the reason the certainty is low is we're trading things that are completely unpredictable. We're trading human emotions. That's really what volatility is. Whether we're talking about option values of the E-mini S&P or the VIX itself, we are trading human emotion. And as humans, we're illogical and we're volatile. There's generally 4 traditional ways to play volatility, but some are more efficient and accessible than others. Today we're going to focus on the first 2, mostly because I think they're the most efficient methods, but secondly because I'm a futures and options broker. I'm not a stock broker. So we'll leave ETFs, ETNs, and equity index options on the shelf for now. In my opinion, those products happen to be relatively inefficient. In fact, if you're talking about ETFs on volatility, extremely inefficient, and they're not meant for buy and hold trading. And we're going to talk about VIX Futures. They're not necessarily meant for buy and hold trading either, but there's a few things that you could do in the futures markets, such as sell S&P puts, to hedge some of that erosion risk, and we're going to go into detail on that. The VIX futures are extremely efficient. I know I put relatively efficient on the slide, but they are actually very efficient, and they're in real time, and they trade nearly 24 hours a day. But the problem with them is they're highly leveraged. The stakes are high. Just as a reminder, if you're long the VIX, you're long volatility. If you're short the VIX, you're short volatility. E-mini S&P options are a roundabout way of playing volatility. For example, if you're buying puts, you're long volatility, and if you're selling puts, you're shorting volatility. And again, we're focusing on the put side of the option market, not the calls, because when we talk about volatility, we're generally talking about a decline in the stock market. The great thing about E-mini S&P options is the barrier to entry is very low. You can find cheap options. You can trade them in a small account, and there's basically 24-hour market access. But there is relentless time value erosion, and that makes buying an E-mini S&P puts an expensive venture. Your timing has to be perfect. So what is the VIX exactly? The VIX, I like to call it a futures contract with a twist. According to the CBOE, which is the Chicago Board of Options Exchange, the VIX is a key measure of market expectations of near-term volatility conveyed by the S&P 500 stock index option prices. What that means is the VIX is dependent on implied volatility. If the market expects volatility, the VIX goes up, and so do option values. Now, the thing is, most traders, probably all of you have heard of the VIX and you understand what it is, but few really understand the complexities of the VIX futures as a trading vehicle. The VIX future is the only product traded on the CBOE, or I should say the only futures product on the CBOE, and that is a big important characteristic because it follows different rules than many of the other futures and options markets that are traded on the Chicago Mercantile Exchange or the ICE Exchange. Because it's a different exchange, there's different rules, there's slightly different trading times, different market types. It gets complicated, but you should be aware of those types of things. For example, in the overnight section, or the overnight session in the VIX, they don't accept market orders. So if you're panicking and trying to get out of a trade and you sell your VIX at the market, you're going to get the order rejected, and you're not going to know why, and it's going to be stressful. So it's important to know that it's traded on a different exchange, it has different rules, and it's a little bit tricky. The great thing about the VIX is it gives speculators an opportunity to directly trade human emotions. During times of complacency, the VIX falls, and when investors grow emotional, the VIX rises. The VIX is not an investment. If anybody tells you they are investing in volatility, they really don't understand what they're doing, and they're probably going to lose money. The VIX is a highly speculative, no mercy trading vehicle. The VIX futures makes or loses $1,000 a point. So if the VIX goes from 15 to 16, you made or lost $1,000. And if you've been following the VIX for any length of time, you know that that's really just a blip on the radar. That's not a big move. The great thing about the VIX is it generally dribbles lower, but when it does go up, it goes up in a massive, massive way, and that's why people are lured to the VIX market. It's not uncommon for the VIX to go, or the VIX futures, and keep in mind I am speaking about the VIX futures, not the equity index, which really isn't tradable. It's a little bit different. And the VIX futures, because it's pricing in volatility for a future date, it will always trade higher than the CBOE VIX reading that you see on your TV, on CNBC, or whatever news channel you're watching. So if the VIX futures contract gets down to 14 or 15, that's actually really, really low. Whereas the cash market VIX, you may see somewhere around 10 on the really low side. So just keep that in mind. But it's not uncommon for the VIX futures to trade from 15 to 25 in a couple of days. Does it happen constantly? No. But maybe 2 or 3 times a year, that sort of thing does happen. And so if you happen to be along for the ride, it can be a really great trade. Just imagine from 15 to 25, you're talking a $10,000 move on one contract. The margin on one VIX is about $6,000. Too many beginning traders, they see that the VIX makes those big moves, and they know that it's inevitable that eventually it will happen again, but they're not around long enough to enjoy that. They can't withstand the drawdown, because as the S&P trades sideways, the VIX dribbles lower. It's like an eroding asset, very similar to a put option in the S&P. So the ES, which is the E-mini S&P, and the VIX are negatively correlated. It seems obvious, but some traders don't realize that in regard to the VIX, volatility strictly refers to a bearish move in the S&P, and we've kind of already discussed that. The VIX declines when the S&P trades sideways. The VIX declines when the S&P makes a violent move higher. The only scenario in which the VIX rises is in a volatile move lower in the S&P, or the anticipation of such. Remember, we're trading expectations of volatility and emotions just as much as we are volatility. So sometimes the VIX will go up even if the S&P isn't necessarily going down because people are expecting a change in market sentiment. But the point I'm trying to make here is if you're long the VIX and you're perpetually long, say meaning that you buy and hold it, the only way you're going to make money is if the stock market goes down. In normal market conditions where the S&P is trading sideways or going higher, you're going to lose money, not because you were necessarily wrong, but because you weren't right. The VIX has a propensity to grind lower throughout time unless something unusual happens. And that can be very expensive and very painful for anybody that's long the VIX. Okay, so this is a depiction of how inversely correlated the S&P versus the VIX truly are. I mean, it's obvious that the VIX here is in the blue. So this represents the VIX, and this represents the S&P. So somebody that was long volatility without any hedge might have suffered quite a bit during this sideways pattern in the S&P because the VIX just simply lost value, even though the S&P wasn't necessarily going up during this time, but it wasn't going down either. And that's all it takes to lose money in the VIX. That's what makes it so difficult. The VIX basically trades like a long option. As I mentioned before, it erodes like an option. And this is probably a better chart of what I'm talking about. You notice the S&P up here is trading sideways. It's not going anywhere. But somebody thinking that volatility is low, the S&P is overbought, eventually something has to give, and they go along the VIX. For the long term, they'd have to hold it for a long time and suffer a really big drawdown before it finally goes their way. And this happened to be a particular time in which the trade would have massively went their way, so it might have, would have eventually been worth it. But most traders probably wouldn't have stuck around. If you notice, the VIX is starting out at around 19.5 and bottoms out around 16.5. So that's a $3,000 loss on one contract before things go their way. So we're going to show you what you can do to hedge that premium erosion that occurs in the VIX if you happen to be early to the trade. So this is basically just explaining what we saw in that previous slide. Each day that the S&P either moves higher or trades sideways, the VIX loses value. And so it's a lot like being long a put option in the S&P. Anyone that's ever bought a put option in the S&P knows that if your timing isn't perfect, the option erodes away and you lose money. Even though you weren't necessarily wrong, you might buy a put and the market doesn't go up, maybe it just trades sideways. So you weren't necessarily wrong, you just weren't right. And again, that's enough to lose money. But there is another way. If you have the wherewithal to trade the VIX futures, meaning the capital and the guts to do it, you could go long a VIX futures contract and then you could hedge it with a short E-mini put option. And what this does is it reduces position volatility, it hedges your time value erosion, and it mitigates risk. So as the S&P is trading sideways, the VIX might be dribbling lower against you, but hopefully you're making some of that back in premium erosion in your short put. So basically the strategy would be to go long a VIX futures contract, which, as we've mentioned before, and I actually talk about this in my book. Higher probability commodity trading, we talk about this. There's an entire chapter on trading the VIX. And honestly, if you had enough money and you had enough guts, you'd probably have a hard time losing money in the VIX. Because at some point, the VIX always rebounds. And when it does it, it's massive. It does it all at once. So it'll dribble lower for months and months, and then when volatility picks up, it's a massive rally. So if you had deep enough pockets and maybe unlimited time and unlimited money, you'd probably do very well. But of course, none of us have unlimited time and unlimited money. So this is a way to stay in the game longer with less pain and keep your emotions in check. So going along the VIX is basically buying volatility. If you do it alone, it's not only you not only see big swings in your account balance, but you're also going to see the harsh erosion risk. If you sell an E-mini S&P put along with that long VIX, or I'm sorry, if you sell an E-mini S&P put alone, you're actually doing the opposite of buying the VIX. You're selling volatility. So if you did that alone, yes, you would erode, or you would benefit from the premium erosion, but your profit potential would be limited. So if you combine these two strategies, you're basically just hedging yourself, giving yourself open-ended profit potential, or at least substantial profit potential, while hedging your erosion risk. The idea is the short put profits from the premium erosion should be counteracting the erosion of the VIX price if the market volatility fails to rise. So it's taking out some of the sting of waiting for the VIX to make its move. If volatility increases, the gains on the VIX futures contract should outpace the losses on the short ES put or the S&P put. Now, this is tricky because obviously it depends on how volatile things get, how much time is left on your option, so on and so forth. But it should outpace it. Is it going to cut into your profits? Absolutely. But that's just the opportunity cost of having a hedge on. The other thing about this type of strategy, it's easily adjustable. If you put the trade on simultaneously and one of them goes in your favor, you always have the option to take your profit on that particular leg and then hold the other. For instance, it might mean you go long the VIX, you sell an E-mini S&P put, the put erodes to a very low value, maybe even nothing. You might choose to take the put off the table, lock in your profit, and just hang on to the VIX naked, or vice versa. So this type of strategy is the best of both worlds, but it's only for aggressive and well-margined traders. Here's an example of what a trade like this might have looked like. Now, this isn't the most exciting example, but it proves that somebody that doesn't have the best timing in the VIX could counteract that with this type of a hedge. So this trader is basically going long a VIX near 18. And remember, the futures market's VIX is always going to be higher than the cash market. So some of you might be thinking, why the heck would you go long the VIX at 18? That sounds astronomically high. But in the world of futures, it's really not all that high. In fact, it's probably on the low end. So that probably looked like a pretty good deal here to go long the VIX. But as we now know, it wasn't. The VIX continued lower. But had the same trader gone long the VIX and sold the put, by late March, which is right here, he basically would have been out about $650. The losses that on the VIX futures contract would have been almost offset by the gains on the put. And so again, he was wrong. He went long the VIX and volatility declined, but it wasn't so bad. Had he not put on this hedge, had he not sold the 2250 put in the March E-mini S&P, he would have been out roughly, somewhere around $3,000, a little less than $3,000. So again, the idea is the hedge will not only be better for your pocketbook and your trading account, but it should mentally be a little easier to handle if your timing is less than perfect. So obviously, I just want to point out a few of the disadvantages of this type of thing. While it's a higher probability venture than just going at volatility naked, there are some drawbacks. Despite the hedge, this trade is double margined, and that's because they're on different exchanges. So you're selling an E-mini S&P put, which is traded on the Chicago Mercantile Exchange, and then you're going long a VIX futures contract. Those aren't going to be cross-margined. If you've ever traded futures and options, you know most positions are cross-margined, meaning it's portfolio margin. They'll net your total risk. But in this particular case, there is no margin break, so you're fully margined on both sides. So you could very easily spend, depending on which put you're selling, margin could very easily be about $10,000 on a trade like that. And that's pretty steep. But if you look at the profit potential in the VIX, maybe it's not as steep as it seems. And obviously, there is an opportunity cost for having a hedge. The short ES put will get in the way of profits if the S&P sells off and the VIX goes up. And unfortunately, it's everybody that, a lot of people tend to want to have a mathematical formula that's going to tell them how much they'd be making or losing at any particular time, but that would be impossible in a trade like this. The relationship between the VIX and the E-mini S&P, we know it's negatively correlated, and we know that the put option is going to lose value as the VIX is losing value, but when volatility strikes, we don't know when that's going to be. You can't predict what the relationship is going to be at that time. You can't predict how much time value is going to be on the option. There's all types of things that make calculating that impossible, at least in advance. So hopefully, if you've learned anything from today's presentation, you learn to be creative. Even if you don't like this idea, maybe it opens your mind to the potential of just being creative. Don't make the mistake of utilizing the same simple strategies that everybody else uses. Everybody else loses money, or not everybody, but most people lose money. So if you're just sticking to the simple go long, go short, and place a stop loss order, you're probably going to lose money alongside with them. So open up your mind, think outside of the box. All right, I want to thank everybody for coming. We appreciate the support. And again, if you visit DeCarleyTrading.com, you can sign up for free newsletters. There's a lot of educational videos and articles and things like that. And if you're interested in learning more about the VIX and trading commodity options and futures in general, please visit our website, higherprobabilitycommoditytradingbook.com. Like I said, if you buy this book, I'll autograph it, and we'll also send you a free copy of Currency Trading. Or you can buy that book on Amazon for a little cheaper. Okay, I think I have a couple minutes left. I'll try to answer a few questions here. Somebody's asking, wouldn't you be better off to sell an SPY put spread against the VIX future? In my opinion, no. I mean, I'm a futures and options broker, so obviously I'm probably a little biased. But the benefit of doing it in the ES market is you have 24-hour market access. Depending on your situation, you maybe even have better tax treatment for the trade, and probably going to be lower margin. So I would prefer to do it in the futures markets. And somebody's asking, what's the difference between trading the VIX and trading the VXY? The VXY is an equity market product. I believe it's an ETN, I could be wrong, but the bottom line is it's extremely inefficient. You're basically trading a stock product that is a derivative of a derivative. It's a little nuts to me. And most of those ETFs and ETNs are not meant for the long haul. You can day trade them, and if you happen to be right during that day, then that's great. But if you buy and hold them, even if you're right and volatility goes up, you're almost certain to lose money. They're super inefficient. Somebody's asking if VIX futures have much slippage. When volatility is high, you can see some slippage, yes. They move quick. They're very liquid, but just like any other market, when things get wild, they get extremely wild. But in normal market conditions, you're not going to see a whole lot of slippage. All right, so somebody's asking about selling a VIX call and buying two. You know what's really odd about the VIX futures is there are no options written against the VIX futures. So you can trade VIX options in the stock market, but you can't trade VIX options in the futures market, which is what we do. So it's really more complicated than it should be. But we trade a lot of options on E-mini S&P, commodities, things like that, but we don't have access to VIX options because, like I said, we are a futures and options brokerage firm. We don't offer stocks, so that's a little out of my realm. So I think that's it. I think we're out of time. I appreciate everybody coming. If you have any questions, there's my information. I'd love to hear from you.